So today we're going to be talking about funding an industrial property or any property in general, but particular focus on industrial, seeing as that's been the theme. So as you know from the last, this is the fourth webinar we've done in our webinar series. So the first one was just a quick overview of commercial property and investing. The second one was the cap, taking you through cap rates. So that's how to influence value and the leases with commercial property. And then the third one, last week's one, was focusing on the valuation and a bit more detail about the cap rates. So today we're going to be talking about the funding, so how we can get funding for properties and how we can finance it. So today we've got our guest speaker beside me, which is Krish Krishna. So he's the founder and director of Mortgage Suite. So a really good mortgage brokering company. He's done 1.5 billion in lending, 18 years experience in banking. So 18 years with the ANZ and 10 years with Westpac. So a total of 28 years. You don't look it. So specialist in corporate and commercial banking. Correct me if I'm wrong on any of these. So so really good experience and really good at arranging finance. So 23 years of having his own mortgage brokering business, and he's a property investor himself. You've personally helped me with a few of my own personal investments, and you've helped us with our property fund as well. So I'll let Krish take it away, and he's going to explain to you today about funding and financing commercial property. So over to you, Krish. Thank you.
Thank you, Jack. And thank you for inviting me to start with. Firstly, I just want to say to any of you out there feeling the effects of the flood and obviously the storm you've had, hope you guys are keeping safe. And if you have damages to your properties, obviously you need to get in touch with your insurance companies, and the banks are also there to help you out if you do need any form of assistance. There are schemes being put in place for the banks to help their clients who have been affected. So so get in touch with either your advisors, your insurance companies, or the bank directly. Most of you probably have had borrowed money in the past, either directly through the banks or use the mortgage broker, especially for buying your own homes or residential properties. It's pretty simple when it comes to residential properties. The main thing that banks look at is your ability to service the debt. And if you have the income and if you have a deposit, the banks lend you the money. But when it comes to commercial properties, it's slightly different. So we'll look at two different types of commercial properties. One as owner-occupied property, and the other one as an investment. So what do the banks look at when it comes to owner-occupied properties, and also if you are an investor? So we'll look at this in depth a little later. So the main criteria that the banks look at is the three main criteria. One is a loan-to-value ratios, and it can go up to 65%. That means you've got to have a minimum of, say, 35% in deposit or in equity. The other main criteria is quality of lease, and obviously then the cash flow from the business or the rental properties. So we'll go in detail a little later on that. But let's look at owner-occupied commercial properties. Again, the maximum LVR is 65%. So what the banks do look at is your ability to service the debt. How would the business pay the property off? And the maximum term is 15 years. So assuming you are renting your commercial property at the moment, and you are paying, let's say, 100,000 in rent, and you are making, after making your rent payments and all your business commitments, you're making a profit of, let's say, $200,000 a year. So the income that the bank will factor in your debt servicing is the 100,000 rent that you pay, plus your 200 profit, which is 300,000 in total. Then that total income, 300,000, whether can it service the debt that you're proposing to borrow on a commercial property. So if you look at a $2 million property, for example, the $300,000 will then be used to, with the interest rates on the day, to give you a 15-year principal and interest payments. All mortgage payments on properties for commercial properties are on 15-year term, and it's based on principal and interest basis. Sometimes the bank will help clients manage the cash flow by just giving interest-only facility, but the actual debt servicing calculation will be based on 15 years. And if you pass that 15-year loan term, then you can structure the loan, balance of the loan on a interest-only basis as well. So that's for owner-occupied properties. Slightly different when you go to investment properties. For example, if you're an investor looking to buy a commercial property, then again, maximum loan to value ratio is 65%, but generally 60%. It has to be a really, really good deal for the banks to go up to 65%, generally limited to 60%. But the key criteria here are the leases. The banks actually assess the lease and the quality of the lease. What goes into the quality of the lease is who owns the lease, who are the lessees, the mix of tenants, number of lessees you will have in the property, the lease term on each of those leases. Then they work out on average lease term for the if you have 2 or 3 different tenants in there. We also look at the nature of industry they are in. And that's one of the most significant things that the banks look at these days in terms of what the tenants do, what sort of business they are. So basically, they're also, apart from analyzing you as a borrower, they're also analyzing the tenants. The banks have a long history in terms of dealing with commercial properties. Sometimes they can actually come back and tell you that we're not comfortable with certain tenants because they have got a history with those tenants. And they might say, well, though you might think that the tenant is good, but we know more than you about this tenant. So they might turn around and say, whilst everything else fits in the criteria, we're not comfortable with this tenant, without giving you too much details about the tenant. So sometimes they actually decline can help you in choosing your tenants as well. So the quality of the lease, again, is very, very important to the bank. At the moment, the most popular properties that the banks will lend on is industrial. Offices used to be, unless it has to be, unless it is a really, really good quality offices with good quality tenants, it's very, very hard to get funding on retail in office type dwellings at the moment. So the main one is industrial. Yeah, but again, having said that, the other, it's certainly not by no means you can't get any loan on retail and offices. They do have to be pretty strong. So let's look at borrowing. Can you actually borrow 100% if you have equity in residential properties? This is most common questions we get, and the answer to that is yes, we can. How that is worked out, and say, for example, you've got a residential property valued at say $2 million, and you have a current home mortgage of $400,000. The maximum lending value, what the banks will see, is 80% on an owner-occupied property. Obviously, if you're leveraging against a residential investment property, then it is 60%. So let's say in this example, you have 1.6 million in lending value. So there's a maximum the banks will lend you on that property. So you have, let's look at the next slide here. So you have an equity release of 1.2 million available towards the $2 million purchase. So okay, so looking at that same example, so you have a in the previous slide you said $2 million of value in your residential property, and you've got a $400,000 mortgage. Your lending value is 1.6 million, and now you have an equity release of 1.2 million. So how we restructure it, for example, if you are buying a commercial property with $2 million, we can actually raise 1.2 million on a residential loan, and the balance 800,000 on a 15-year commercial loan. The advantage with getting a residential loan is two. The advantages are two main ones. One, you get a 30-year mortgage, so that reduces your loan payments down. And secondly, interest rates are generally lower than the commercial property loan. Again, debt servicing is based on residential lending criteria mixed with commercial lending criteria, so it makes it a lot easier to borrow on commercial property for 800,000 as opposed to borrowing the whole thing on $2 million in commercial loan. Again, this is not a financial advice. If you trying to structure in such a way, you need to talk to your accountant as well.
Just on that example,
Yes.
just a quick question on job. There'll be Q&As at the end.
Yeah,
so
yeah,
that's sort of
yeah,
last one now. If we had did this structure, so we got the 2 million, 1.2 against the residential property, and the 800 against the commercial property, is there a chance that the bank could give you interest only on the commercial property loan portion?
Yes,
And not the residential loan portion?
not the residential loan portion,
Yeah.
but commercial, yes.
Yeah, that's awesome. That can be really handy in servicing. And this
It
provides
does help, and it's a very common way to structure commercial property loans at the moment.
That's really interesting.
All right.
Awesome. So yeah, Phil, thanks for that, Chris. There'll be some Q&As at the end.
Sure.
Just as a bit of a pitch for our fund once again. So how it relates to what we're doing. So our property fund is to create a diversified portfolio with value add properties. So as we talked about, I think last week in the valuation, our whole concept and what we're trying to achieve with the fund is constantly building value add and also rental increases. So into our portfolio, from renegotiating the leases and also increasing the rent. So as part of that, as we're building that portfolio, we can also look at funding arrangements and also to get to use that equity to buy more property, but we're always constantly doing capital raises as well. So we're trying to buy more property which has that value lift upside in it. So we look at properties that are under rented so that we can unlock that future upside, or angles that we can actually increase the equity on within the fund itself. So that's our overall strategy. So we're only buying industrial properties. That's all we stick to. It's always value add, and we're looking at areas that have always got growth so that we don't have any vacancy loss or minimize that vacancy loss. So it's real easy to switch a tenant in and out, especially in the industrial precincts within Auckland. Hamilton's got some really good, strong industrial tenants at the moment. We are considering Christchurch, and we have and are considering New Plymouth as well. So, and we'll always look at properties into that $5 to $10 million range. So that's just a bit of a pitch about the fund, but now we'll open up to Q&As, I think. So we'll just stop sharing this presentation now. And if anyone's got any questions for Krish or myself, feel free just to unmute your mic and ask a question, or feel free to type in the chat bar. So yeah, feel free.
Oh, that's easy then.
Yeah. Is there quite a lot of lending applications going through for commercial property at the moment that you're seeing, or?
Yeah, there's a reasonable amount. I wouldn't say a lot going on.
Yeah.
But yeah, we do see a little bit of that happening. When it comes to commercial property funding, the banks seem to be more interested in sort of larger type properties,
Yeah.
as opposed to little ones. Because they have specialist divisions in the bank, which is property finance sector, and they have a minimum lending criteria over there as well. So sometimes it's a lot easier to get properties that are really high value properties as opposed to getting lending on a smaller one.
Yeah. That's part of the property fund itself. We've just got one, they've just got a GSA structure, general security agreement over the fund itself. So it's really easy for us as we increase the value. Our lending covenant's only 45%. We can't go over 45%. Right now we're sitting just shy of 40%. So as we increase that value, we've got that.
Yes, you know, the margin to play with.
So that's what makes it easy for us.
Yeah.
For individuals. Exactly. So just check the chat.
One of the things, has any of the properties been affected with the flooding?
Oh, that's a question we get quite a lot. So So the short answer is no, luckily, which is really good. We did have four properties that were affected from the first downpour, so that first initial flood that we
Yeah.
Four of the properties, they didn't flood, which was good. It was just that the gutters that we had couldn't cope with the amount of rain coming down, so they overflowed into the warehouses. Luckily, it just ran down the walls of the warehouses itself. No equipment was damaged, and luckily those warehouses were just manufacturing, so they were able to sweep it out very easily. So there was no actually lasting damage as such, touch wood, which has been really good. So we haven't had to have any insurance claims for the properties affected by the floods that we manage. So just a few questions have come up here. So we've got the first one is, how long does it take to process an application?
Good question. How long is a piece of string? Yes, commercial applications do take longer than the residential ones. We normally say to the clients, just get 20 working days due diligence, and that gives us sufficient time to then work through with the banks. The banks are slower on commercial applications, and a number of things go into it, and they have different ways of working out. So the time taken is to understand the lease, and generally it takes longer. So we say to the clients, take 20 days working due diligence as a starter.
Awesome. And another question is, does the bank favor lending to institutions such as yourself compared to, say, an individual investor?
No, they don't, and they can't do that either. What the difference that a commercial broker can make is by putting the application together so that the bank understands the all the details better than with an individual just putting all the information and giving it to the bank. The banks like to see it in a structured format, and we are also able to then use our experience in basically requesting the bank or showing them how and why the interest rates, why they should approve it, and why the interest rate should be lower than the standard rates. So they work through different risk profiles of a client, and then they internally they come up with a risk rating for that application, and the interest rates are based on entirely on that risk rating, the risk profile that they put against that borrower. So it always pays to go through a broker who can then put it in a language that the banks understand better.
Another question is, what is the current interest rate spread with banks?
It's a very hard question to answer when it comes to commercial properties. The reason being, again, following on from my last answer, is the risk profile of that portfolio of that property. So, for example, if you are graded as a grade, let's assuming A to D grade, and they put you in the C grade category, they probably get a higher interest rate than if you're in the A grade category. But looks like if you have a C grade category, you probably won't get an approval either. So the risk band is about 2%. So, for example, good clients like Provincia will get a premium rate compared to a individual borrower will be on the higher end of the scale.
Yeah, exactly. Another one is, what is the max LVR for interest only? Well, that's a good question.
Yeah, so the banks don't work on LVRs in terms of interest only. They work on the basis of on a 15-year term, but within that 15-year term, they can give you a maximum of 5 years on interest only basis, and then the balance was 10 years. As long as you're able to amortize the balance of the debt over 10 years, then the banks are comfortable lending to you on interest only basis. It's easier to get an interest only facility if you have less than 50% LVR than 60%. So if you're borrowing at 60%, you may have to really convince the bank as to why you need interest only facility. Whereas if you are 30% or 35% borrower, then it's a lot easier to get interest only facility.
Thank you. Oh, here's one for me. So the question was, Jack, you mentioned possibly looking at CC, so Christchurch, so looking at Christchurch to invest. Why is that? What about the earthquake risk? So that's a really good question. Christchurch right now, they've had quite a lot of industrial rebuilt since the earthquake and some really good new builds. So that's something that we are looking at down there. And the thing that attracts us to Christchurch is it's got the second largest population in a city in New Zealand. So Auckland's your number one, Christchurch is your number two. And industrial property, the precincts there's some really good industrial precincts down there that weren't affected as much by the earthquakes, number one. And number two is that a lot of it has been rebuilt, or a lot of new stock has been introduced. And what we're looking at down there is the vacancy rates. The vacancy rates have actually been really low. And so that's something why we're considering looking down there, because I think it's definitely under rented. The square meter rates are lower. And we think there's going to be quite a bit of growth. So that's something we are considering doing. Not saying we will, but it's something to definitely look at, because the indicators is right now with low square meter rates, low vacancy, which is interesting, and those new build properties present quite a good looking opportunity. And there's a really good tenant covenant down there at the moment as well. Is there much space left in Auckland for industrial? Yeah, that's a good question. And again, that's partly why the demand is being so high in areas like Wiri, like East Tamaki, Rosebank, Mount Wellington, because those pockets have been basically fully built out. So that's something we call brownfield redevelopment. So they're basically, the sites have already got industrial on them, but they're quite some areas of East Tamaki, some areas of Mount Wellington are quite older buildings. So that's one opportunity, is to redevelop them into new buildings, or areas in Auckland that could grow to, is I guess Hobsonville, Humu, those areas have been designated for future growth. And also like Drury's got a whole lot of new development happening out there, but again, you're getting further and further out, and that's what's pushing up demand, especially within closer to the city, especially like Mount Wellington. The square meter rates are really high right now. There's such a demand to be closer to the city and closer to those transport hubs. So it's going to be interesting, but that is what's keeping the square meter rate and demand high, even though interest rates are increasing in this environment. Any other questions? What is happening in Hibiscus Coast? Oh, that is an interesting one. So Silverdale area.
Yes.
Yeah.
Or Silverdale.
Yeah. That's an interesting one, because there is space up there to redevelop. There's been some developments happening. I have seen some new builds. Little bit of vacancy, but I mean that is filling. So I guess if you're buying it and it's close to the transport hub, so that could be some space for some good opportunity. We haven't seen too many opportunities that we'd jump at, but there could be some good ones, especially smaller ones for individual investors as well. When is the next revaluation coming out? So that's a good question. So that's actually happening on the 31st of March. So for the fund, we get our portfolio revalued on the 31st of March every year. So the valuers actually have been engaged right now. So CBRE, Telfer Young, which is now bought out by CBRE. So they're revaluing the entire portfolio right now, and the valuation would be due out. The valuation date would be 31st of March. And once the auditors have gone through that, so that's the process, is we get the valuations done as of 31st of March. The financial accounting and reporting's done, auditors go through those vals, and then it's been released as the new share price. So it'll be back set to the 31st of March. There's another question there. Here it is. How do we syndicate to borrow and buy industrial property? So setting up a syndicate to borrow and buy.
Is it for a syndicate or is it individual?
Yeah, so it's a bit of an ambiguous question there. So if you're setting up for a syndicate, I guess you'd want to, we're actually talking about that next week. So
Right.
next week's session is actually talking about the different structures like what we have with Provincia.
Yeah.
So the whole fund, the whole structure of the fund itself versus other ways to structure either businesses or syndicates. So that's something we'll talk about next week. But I guess, I mean, a short answer, if it's a syndicate, I guess there'll be a limited LVR or a GSA over that business.
Yes.
Would that be?
Yeah,
Yeah.
yeah. Again, the banks will factor in the high interest rate in working out your debt servicing. But if you're a personal borrower, then if you have cash, then yeah, just pay for that instead of borrowing from the bank.
Yeah, so that could be the other way to do it.
Yeah.
Another question is, in a high interest rate environment, is it worth taking a loan from the bank or pay everything with the cash?
Pay everything with the cash if you got the cash. If not, use others' money. But yeah, again, yeah. You may want to wait until the interest rate moves down to buy, but if you got cash, yeah, always recommended use your cash.
That said, there can be some good opportunities coming in the market though.
Yes.
So that is the trade-off, like that's what we're seeing, you know, the counter-cyclical opportunities, and there's some really good buys at the moment, especially with the square meter rate. The market rents haven't actually been adjusted probably in the last 2 or 3 years. You know, square meter rates we're seeing really shoot up, especially in the East Tamaki area at the moment. It's going north of 150, 160, some spaces even higher. So a lot of those properties that you could buy now, it's just, you know, if it's a good opportunity and it's under rented, there could be opportunities to do that. But again, you have to make sure you've got the finance arranged and offset against those higher interest rates. But there will be uplift in terms of rental in the future built into those.
Yeah, definitely.
Any other questions? It's quite really good questions today.
Yeah, good one.
Yeah.
Good air speakers.
Yeah. Oh. Oh, well, if there's not any more questions, if anyone thinks of anything afterwards, feel free to give us a call. You can give myself a call. I'm sure you want to take some calls, or if anyone wants to speak
Yeah,
to Krish,
definitely.
correct?
Yeah, we got my numbers. In the system. Yes.
Yeah.
So yeah, but feel free to email me or give me a call. If you have anything to talk about or discuss.
Yeah, or check out the website.
Or check out the
Mortgage
website,
Yeah.
yes. Or even if you want to have a review of your existing portfolio, just yell out and we'll go through that as well.
Yeah. You've helped me out a lot with that personally to unlock some really good value in it. So that's a really good idea as well. Awesome. So thanks to everyone for listening in. So again, we'll be online next week, 12:30 on Thursday, to discuss the structures. So the different structures that you can put in place, different syndicate structures, and the structure of our property fund and other property funds. So I believe it's going to be Carl and myself once again. So we'll see you all next Thursday, 12:30. Awesome. Thank you for listening.
No, thank you. Take care.
Thanks for the webinar.
Thank you.
Thank you.
Unfortunately, we won't be here next week.
Okay. Well, I think there might be a recording. So if you register, Laura might be able to send out the recording.
Excellent. Thank you, Laura.
Thank you.
Thanks, Hazel.
Thanks. Bye.
You guys.
Oh.